When Japan raises interest rates, it impacts the yen, which is often used as a funding currency due to its low cost. Investors borrow in yen to invest in high yielding assets, a strategy known as the carry trade. This works well under normal market conditions, but when the Japanese government intervenes to strengthen the yen, it disrupts these trades. As the yen appreciates, those positions become less profitable, forcing investors to reduce risk. In financial institutions, this risk management is called value at risk. If the yen or other major currencies experience significant moves, investors are compelled to liquidate other assets to manage their overall risk. This can trigger a chain reaction across global markets, including selling off riskier assets like the Nasdaq. As investors reduce exposure to volatile positions, the impact cascades through different asset classes, leading to a situation where markets previously uncorrelated start moving in tandem. This phenomenon explains why a single event can cause widespread market correlation.
When Japan raises interest rates, it directly affects the yen, which plays a significant role in global finance as a funding currency. Due to Japan's historically low interest rates, many investors borrow in yen to invest in higher-yielding assets elsewhere, a strategy known as the carry trade. This approach works well under stable market conditions because the cost of borrowing in yen is cheap, allowing investors to profit from the difference between the borrowing cost and the returns on their investments. However, when the Japanese government intervenes to strengthen the yen, it creates a ripple effect that disrupts these carry trades. As the yen appreciates, the cost of repaying yen-denominated loans increases, making those positions less profitable, or even leading to losses. This forces investors to reduce their exposure to riskier assets to avoid further losses. In the financial world, this risk management process is known as value at risk. VaR measures the potential loss in value of a portfolio due to market movements. When the yen or other major currencies experience significant volatility, institutions must liquidate positions to manage their overall risk levels. This liquidation often begins with the most volatile or riskier assets, such as those in the Nasdaq, and can trigger a broader sell-off across global markets. As more investors are forced to reduce their positions, this selling pressure spreads to other asset classes, creating a chain reaction. What starts as a currency movement in Japan can lead to a synchronized decline across various markets, even those that weren't previously correlated. This phenomenon is why a single event, like a sharp move in the yen, can lead to a situation where different assets, which usually behave independently, suddenly start moving in unison, creating a broad market sell-off.
Subscribe our channel and press the bell button to get our video notification. And like the video.
Over the past 2 decades, we've often seen a secondary dip in markets before a recovery takes hold, and that's where I believe we are now. While this may seem like noise, it's important to consider that the markets I focus on, crypto and technology, are primarily influenced by liquidity and financial conditions. Currently, we're at a relatively slow point in the economic cycle, where rate cuts are becoming increasingly likely and almost inevitable. Several factors support this outlook, particularly the unemployment rate. For some time, I've anticipated that unemployment would rise, and while I don't expect it to skyrocket, we have now reached a point where the unemployment rate exceeds even the most pessimistic forecasts from the Federal Reserve's hawkish members. This is a clear signal that the economy is weakening and that rate cuts are on the horizon. The combination of rising unemployment and slowing economic activity suggests that we are re-entering a phase where central banks will need to ease monetary policy to support growth, which is likely to have a significant impact on markets, especially those driven by liquidity like crypto and tech.
Over the past 2 decades, market cycles have shown a recurring pattern. A secondary dip often occurs before a sustained recovery begins. I believe we're in that phase now, where the market noise is increasing, but it's essential to focus on the underlying drivers. The markets I concentrate on, crypto and technology, are heavily influenced by liquidity and financial conditions. Right now, we find ourselves at a relatively slow point in the economic cycle, where the prospect of rate cuts is becoming more of a certainty rather than a possibility. The likelihood of rate cuts is supported by several key indicators, with unemployment being one of the most significant. For some time, I've been expecting a rise in unemployment. And while I don't foresee an extreme spike, we AV now reached a level where the unemployment rate is higher than the forecasts of even the most hawkish members of the Federal Reserve. This development is crucial because it signals that the economy is weakening more than expected, pushing central banks closer to cutting rates. As we move further into this phase, it's clear that the economic slowdown is beginning to outweigh concerns about inflation. The combination of rising unemployment and slowing growth suggests that the Fed and other central banks will soon need to ease monetary policy to prevent a deeper downturn. For markets like crypto and technology, which are highly sensitive to liquidity conditions, this shift could be significant. The anticipation of rate cuts could lead to a recovery in these markets as investors respond to the prospect of easier financial conditions and improved liquidity, setting the stage for the next phase of growth.
Let's discuss the current market cycle and how it impacts asset allocation, particularly in crypto. Back in 2019 to 2020, Ethereum ETH was a smaller token compared to now. During that period, ETH experienced a 67% pullback, while Bitcoin saw a 51% drop. And another time, ETH dropped 68%, while Bitcoin fell 62%. This highlights a key point early stage. More volatile tokens tend to underperform during market downturns, but can significantly outperform during rallies. When thinking about asset allocation, it's crucial to keep this in mind. That SY prefer to hold larger, more established tokens rather than stretching too far out on the risk curve. While meme tokens can be fun, and I do hold some, they make up no more than 10% of my portfolio. I strongly advise the same. Don't allocate more than 10% to these high-risk, highly speculative assets. Yes, they have the potential to deliver 100x returns, but even with a small allocation, you can still make substantial gains without risking your entire portfolio. If your entire portfolio is in these risky assets and they drop 99%, the consequences could be catastrophic. This ties into the broader Don a T mess this up thesis. It's essential to manage risk wisely.
Let's talk about the current market cycle and how it should influence your approach to asset allocation, especially in the crypto space. If we look back to 2019 to 2020, Ethereum was still a smaller token, and during that time it experienced significant volatility. For instance, when Bitcoin dropped by 51%, ETH fell by 67%, and in another instance, Bitcoin declined by 62% while ETH dropped by 68%. This illustrates a crucial point early stage. More volatile tokens tend to underperform during market downturns but can significantly outperform during rallies. Understanding this dynamic is essential when deciding how to allocate your assets. That's why I advocate for holding larger, more established tokens rather than pushing too far out on the risk curve. While meme tokens and other speculative assets can be enticing, and I do hold a small amount myself, they should comprise no more than 10% of your portfolio. I strongly advise keeping this cap in place. While these assets can potentially deliver 100x returns, they can also plummet by 99%, and if they make up too much of your portfolio, the impact could be devastating. This approach is central to what I call the "don't mess this up" thesis. It's all about managing risk carefully and ensuring that your portfolio can withstand market fluctuations. This is especially important when considering the so-called banana zone, where a lot of excitement and expectations are centered. It's crucial to understand that the banana zone isn't about instant results. I've never promised quick returns. Instead, I've emphasized that this is part of a broader timeline. Success in these cycles requires patience, strategic allocation, and a solid understanding of where and how to take risks.
Subscribe our channel and press the bell button to get our video notification. And like the video.